What's up everybody, Jaspreet Singh here, and just yesterday the Federal Reserve Bank raised interest rates by 0.75%, and this is after last month where the Fed said that they only plan to raise interest rates by 0.5%. Now this 0.75% interest rate hike is the highest interest rate hike that we've seen in decades now, and the Fed said that the reason why they're raising interest rates by 0.75% is because they got inflation wrong. Inflation is worse than what they expect. Right after they announced the increase in rate hikes, they held a little press conference where Jerome Powell, who was the chairman of the Federal Reserve Bank, answered some questions, and a reporter asked Jerome Powell, why did you raise interest rates by 0.75%? Why not just do 1%, or why did you not do 0.5%? What made that decision for you? And what he said was, we decided to look at the economic and inflation factors. And we expected that by today, inflation would have been on the deceleration. It would have been going down. And inflation is not going down. It's not even plateaued. In fact, it's actually accelerating. And because of where inflation is and where inflation is going, we realized we were wrong about inflation, so we needed to get more aggressive than we originally thought, which is why they're raising interest rates by 0.75%. That was a very interesting thing for him to say, because right after that, a few minutes after he said that, someone else started pressing Jerome Powell about why they're getting things wrong, why they couldn't have seen this coming. And then Jerome Powell said, look, the Fed is doing a good job. I'm very impressed at how well the process that the Fed is doing is working, because while it might not show in the inflation reports yet, he said that we can see that the Fed processes are working and it is lowering demand, and it will bring inflation down and it will help save the economy. So that's what the Fed essentially said. But a little bit after that, the Fed also gave a report, or his thoughts, Jerome Powell, on economy and a potential recession. Because what Jerome Powell said was, it was in response to a question where someone asked him, are you worried about more economic pain coming because of these higher interest rates? And Jerome Powell said, no, I'm not worried about more economic pain because of the Fed policies. However, we could see pain because of external factors, including the war in Russia and things happening in China. So according to the Fed, the economy is strong. The economy will continue to be strong with the higher interest rates, but the only thing that could slow down the economy is Russia and China. So the Fed is not worried about a recession. In fact, they think the economy is very strong. That's what Jerome Powell said again in his meeting just yesterday. So I want to go over three things. One, I want to talk about the Federal Reserve Bank's new policies from yesterday's press release. Then I want to talk about this wage price spiral that he's trying to break. And the third, I want to talk about the implications for the economy. So make sure you watch this video till the end, because there are some things that the Fed says that may not actually work the way that he said. First, in regards to what did the Fed actually say? So the first thing is they raised interest rates by 0.75%, not 0.5%. And the second thing was the balance sheet. The Federal Reserve Bank is now selling off assets on their balance sheet. They're selling off $47.5 billion worth of assets a month. And the goal is to sell $95 billion worth of assets a month by September. And this balance sheet was built up because during the 2020-2021 pandemic, the government was spending money like crazy. They were spending money they didn't have. So then they started borrowing money from the Federal Reserve Bank. And this built up a multi-trillion-dollar balance sheet for the Fed. Now, to fight inflation, they're starting to sell off these assets, and their goal is to sell off $95 billion worth of assets a month. And just to put that in context, when the Fed was building up the balance sheet, they were buying, meaning loaning, about $120 billion a month. So the Fed was buying up at $120 billion a month. Now their goal is to sell eventually by $95 billion a month. So they were buying significantly faster than they are selling it off. Next, regarding the following interest rate hikes, because the Federal Reserve Bank has another meeting in July and then another meeting, or a couple more meetings before the end of the year. And the Fed said that their goal is to raise interest rates by 1.75% by the end of the year. They want to break it up. But we don't know exactly in what percentages they will do it. They don't want to do all 1.75% right now, because they say that that will shock the stock market, the real estate market. It will cause a massive crash, and they want to avoid that, which is why they're breaking it up. But what they are saying is that in July, they expect to raise interest rates by either 0.5% or 0.75%. And the determining factor will be how inflation is doing, because now the Fed says that by them getting more aggressive on inflation with 0.75% of a hike right now, that they will be able to bring inflation down. So they're hoping that inflation will cool down by next month. And they also think that the economy will continue to stay strong and unemployment will stay very low. So that is their prediction over there. And they're saying that they're not worried about an economy. However, they did give a little bit of a warning that they saw that the housing market is slowing down, demand for housing is slowing. And they also said the activity in the investment sector is slowing because people are putting less money into the markets. And that's pretty apparent with now many of the markets in bear market territory. So we've seen the stock markets fall by over 20%, pretty much across the board. The last thing he said is that the risk to inflation now is higher than what it was before. And so the Fed is actively monitoring inflation. However, they're not worried about it because they believe they have it under control. And this brings me to the concept of a wage price spiral, which the Fed is working to break and stop, which is essentially, think of it like you get a higher wage from your job, which means that now your company has a higher cost, and now to pass down this higher cost, they have to raise prices. When they raise prices, now it's a higher cost of living, so you need more money from your job, which causes a higher cost for the business, which pushes higher prices, which makes people want more money, so it creates this spiral. And so the Fed is saying that they don't want more of this spiral. They want to break this spiral, which is one of the reasons why originally they said they want a hiring freeze across corporate America to stop wages from going up. But now what they're saying is that by raising interest rates, they're going to make it more expensive to do business, and this will help break that wage price spiral because it's going to lower demand and that wages won't have to go up by as fast, and that will help cool inflation down. Now, some kind of theories that some economists have proposed is that what happens then if we start to see more layoffs, because we're already starting to see a lot of layoffs across the tech sector, the mortgage sector, even some of the retail sector, because all these industries are getting hit so hard. If we start to see more layoffs, then that means wages are going down. And if that happens, that could give some short-term relief, and the Fed might say, okay, we won the inflation fight, and then they don't do anything else to fight inflation. But that doesn't actually solve the inflation problem, because the inflation problem is the real devaluation of the currency. And so the wage price spiral, while this is something that the Fed is monitoring, they tend to look at things in bubbles. So if we start to see more layoffs and the Fed eases their fight on inflation, that could actually mean that inflation will get worse. And that means that we could enter a stagflationary time where now we're seeing layoffs, we're seeing this recession, and now inflation starts to get worse. So the price of things keep going up while wages go down. So that would be the worst case scenario. And that's something you definitely want to keep your eye on, because while the Fed wants inflation to slow down, they're not so much focused on the economy, at least that's what they're saying right now. They're just focused on the inflation side, so keep your eye on that. And this brings me to the idea of what are the implications to the economy with what the Fed is doing. Now, of course, if you want an easy way to stay up to date on what's happening on inflation, the Fed, stocks, real estate, crypto, and the global economy, you can check out Market Briefs. It is a free financial newsletter that I created. Every day my team breaks down what's happening in the financial markets, and it's a fun and easy to read and witty newsletter. I promise you are going to look forward to reading this newsletter every single morning. I think there's still some people in the office, they're upstairs working on Market Briefs right now. If you haven't joined Market Briefs yet, it is completely free, and I'll put the link to how you can do it down in the description below. So now when we talk about the implications to the economy, now the interest rates are going up even more aggressively. Well, that means that, borrowing money becomes more expensive. It becomes more expensive now to get a mortgage. Housing costs, housing affordability starts to go down. It becomes more expensive to buy a car. Your credit card debt becomes more expensive. But even on the business side, now, if you are a business and you need to borrow money, well, that becomes more expensive. So it becomes more expensive to operate, as well as now if you are a company that's not profitable, this is a real kind of concern that everyone has, especially in the tech sector, is if you are a company that's been relying on outside capital, whether it's debt, whether it's venture capital, well, now the interest rates have gone up even more aggressively. You are going to have a tougher time raising money. And I've been given warnings about this, about, especially crypto exchanges, because a lot of these exchanges are tech companies that are not profitable, that have been relying on their high valuations to stay in business and grow very quickly. Well, now that interest rates have gone up, you can expect these companies' valuations to drop even further because people will need a better return to justify an investment. And if that happens, well, it makes it more difficult for these companies to raise money. And so if you are a company that's not profitable, well, now you're gonna have to raise revenue quicker and you're gonna have to cut your costs quicker. Well, it's hard to raise revenue when you're in a slowing economy because contrary to what the Fed says, the real economy, what most people are facing is that the economy is slowing. And on the cost side, well, that's what causes layoffs. And now if you can't raise money, well, then either you're gonna have to shut your doors, meaning go bankrupt, meaning higher interest rates can lead to more bankruptcies, or you're gonna get bought out by another company. So this is something that you definitely wanna pay attention to because while the Fed keeps saying that raising interest rates won't slow down the economy, the fact of the matter is when borrowing costs go up, spending slows down, slowing spending slows down the economy because less people are going to be likely to buy a home. You can expect that mortgage rates will continue to rise. I mean, mortgage rates have already passed 6%, and now that the Fed has raised interest rates by another 0.75%, you can expect mortgage rates to go up over the next month. And then when they raise interest rates again in July, they probably go up again. So the 30-year fixed will go higher than 6%. Car spending might go down because people don't have the same ability to buy cars as before. Business borrowing will go down, which means you'll see less investment in businesses. And then the companies that have been relying on external capital will have a tougher time getting more dollars because their valuations will drop. So this is something that you want to pay attention to because there's two things. There's the inflation and the economy. And these are two different issues happening at the same time. And right now the Fed is focused on inflation, but they're not worried about the economy. They said the economy is strong, and because the economy is strong, we can do whatever we need to do to fight inflation. And so now their fight is on inflation, and the key question is, how much is that going to affect the economy? If you enjoyed this video and you want to see what 7 investments you should make next time we see a market crash, that way you never have to worry about money again, I made a video covering that, and you can watch that video by clicking this button right over there. Thank you for watching, and as always, keep hustling. Uber, Instagram, WhatsApp, all of these companies were created during a recession.